Hello everyone and welcome to this market update with XTB. My name is Walid Koudmani. I'm the market analyst for XTB UK, the Italian Arabic branch. And in this video we're going to cover gold, silver, precious metals, and the factors to look out for when analyzing those markets. Start with a disclaimer as always. This presentation is provided for general information and marketing purposes only. Free to continue. So, some top news affecting gold. Gold has set new historic highs, breaking through the previous ones just recently this week. Silver is joining the rally in the gold market, reaching the highest levels in many years. Central banks create an ideal environment for further strong price increases in the precious metals market. The gold-silver price ratio may show good prospects for the silver market. That is basically the ratio of how much $1 of gold costs to $1 of silver. Metals such as platinum and palladium largely depend on the prospects of economic growth and fundamental factors, and I will go into that after. So we have a quote from CNBC, the bulls went wild on gold and other precious metal markets. And that can be seen from the rallies seen in those markets and prices. So how far can gold go? That's a question many people ask. So this is all very dependent on a few factors. So the amount of gold in the world compared to central bank balance sheets is very small. So central banks' balance sheets now are inflating because all central banks are increasing their spending massively to deal with the coronavirus pandemic. And therefore, the stocks of gold compared to their balance sheets are actually decreasing. The recent strong monetary expansion by almost all central banks in the world leads to a desire to protect assets against decline in value. Gold is still being mined, but amount of money is growing much faster. So there's still that supply of gold, but the amount of money that's being printed, including in dollars, is increasing highly. Central banks are taking even stronger action than before. We can see from this chart that this is the crisis in 2008-2009. Their balance sheet increase, so how much debt and how much spending they added to deal with that pandemic. The current actions of central banks are much larger and faster than previous crises. A huge amount of cheap money from central banks and fiscal support around the world offers great potential for further long-term gold price increases. We can see that in 2008 there was a significant increase to deal with it, and now it's skyrocketed. And this is the price of gold spot compared to that. You can see that it kind of follows the trend. Gold is also backed by investment demand, so those are ETFs, so exchange traded funds that buy physical gold. Very strong increase in gold demand from ETFs, which is the red line you can see here. This is the effect of a large increase in interest in passive investments, so sometimes called safe havens, things that basically, regardless of what happens in the market, people generally tend to assume that over the long run they're going to increase in value. Gold is currently not extremely overbought by speculators, which is the purple line here. However, the final driving force is the weak dollar. That's something to keep an eye on for everybody. Silver is another market that has gained popularity as of late. And how much should it really cost? Because that, when it comes to commodities like this, sometimes fundamental factors can kind of determine that going into it. First thing to take a look at is silver has very good fundamental factors, that meaning boosting the price. Demand on the silver market has been the highest in years, so the white line here is demand. You can see that it actually is higher than all the previous years, going back all the way to perhaps 2013 or even before that. Funds do not slow down in purchasing silver. Since the beginning of the year, ETFs have increased the amount of silver they own by 43%, and we are only in July. By the end of June, the funds were in possession of 925 million ounces of silver, which gives a 14-month supply on the market. In the first half of the year, funds purchased almost 200 million ounces. The previous record was a full year of 2009 when the funds purchased 149 million ounces. So you can see that just a bit over halfway through the year, funds have already outbought funds in 2009. The Silver Institute indicates that this year supply will decrease by 7%. We're seeing an increase in demand, which goes back years to find something similar, and a decrease in supply, which, according to the laws of supply and demand in economics, and favor the price increasing. How much can silver cost? That is another important question. Silver is still very cheap compared to gold, so the ratio that I mentioned earlier. We observe a very similar situation as during the previous crisis and the period after it, strong increase in gold, silver, and then a decline. as you can see here in 2008, 2009, strong increase, and then a decline. Now we're seeing something similar. Or we could see something similar leading up to there. The price dynamic suggests silver should now be above $40 an ounce. Based on that price, the dynamic of gold and silver. Gold after 2000 with the index adjustment to the historical average shows silver at $30 per ounce though. That's the ratio according to the adjusted. Gold at 2400 though suggests silver at 36 an ounce. So as you can see, as gold increases, silver kind of follows. That is now starting to change as well, and that is subject to the previous factors I mentioned being the fundamental ones like supply and demand. Silver, unlike gold, is characterized by a significant deficit this year, so there's less supply, mainly due to an increased demand from ETFs. So that's what I mentioned. Some other popular precious metals are palladium and platinum, which sometimes their performance varies depending on the markets and the conditions. Will palladium and platinum also have a chance to join the rally? That palladium and platinum are actually still used primarily in the industrial segment. The price increase will depend on the economic outlook, and silver lags behind gold. It is historically characterized by greater volatility. So the first 2 points I'm just going to clarify very quick. Basically, the demand of these two precious metals is also tied primarily to industrial production, and industrial production, as we all know now, is tied to whether they can open or not due to the corona. So those fundamental factors are affected by the pandemic, and the pandemic is affecting obviously the price as a proxy of these precious metals. If things start to get better, these precious metals that are used in industrial production and industrial sector will start to show that effect. How to analyze the gold and silver markets, what instruments to use. Here's a little overview of a few things to keep an eye out if you're analyzing these markets that many people are these days. So the COT, which is the commitment of trader indicator that is available on the Xstation 5 report, shows how market participants are acting, so their performance. And from the investor's perspective, the actions of the speculator are by far the most significant, because if you see the market doing something, sometimes and oftentimes there is a reason behind it, so it's always important to be informed and be one of the people that are moving forward. Secondly, we can look at seasonality, which can be an important aspect in the precious metals market, and that can change. Seasonality is related to the demand, for example, from the jewelry segment, and to changes in the currency market, in particular the US dollar. So we can see that in certain periods of the year, the demand for something changes or increases or decreases based on the seasonality. And another final thing to take a look at are US dollar and bond yields are crucial to the gold market. Behavior of the dollar and the bond market are key in assessing the prospects of precious metals. Central banks' actions affect currencies and bond yields in the long term, which allows precious metals to establish long-term trends, because bond yields tend to be seen as well as a safe long-term investment. However, if those are negatively affected, then people tend to turn to safer or other safe havens such as gold and precious metals. So what's the difference between a CFD and an ETF when it comes to trading gold? CFDs give investors the opportunity to use leverage, and you can speculate on the price going up or down. An ETF reflects the price of $1 billion of gold when investing in physical gold. When investing in ETFs, one should take into account the currency risk, because they are being held sometimes in another currency that is not your home currency. And CFDs already include currency risk in the form of negative swap points that get charged, but are amended in final. So as a summary, we have historically gold as money may still seem cheap. Analysts and Bloomberg's valuation indicate that the price of gold may rise as high as $2,500 an ounce. Based on the current conditions, gold will benefit from the very cheap money that is available on the market, because people tend to invest in those things. Silver is still relatively cheap compared to gold, with the price ratio that I mentioned earlier. The good fundamental situation and lagging behind the gold market indicate that silver should rise to as high, or could rise to as high as $35–40 an ounce, based on the supply and demand and other factors that we mentioned earlier. Metals such as palladium and platinum have to wait for industrial recovery, because they are more tied to their demand in actual production. In the long term, though, it is worth analyzing the behavior of the dollar, bond yields, and the activities of central banks, keeping an eye on them. And in the short term, it will be useful to analyze the positioning of speculators and the seasonality. So, thank you for your attention. My name was Walid Koudmani. Hopefully you found this video helpful and useful, and I'll see you in the next one. Good luck with your trading.